So guys, this week was hands down my worst week on the market so far this year. Taking a look at my dividend portfolio over here on GetQuinn, which is hands down one of my favorite portfolio tracking tools, and you can actually start using GetQuinn for free. There is a link to it in the description of the video. You guys should definitely check it out. But looking at the performance of my portfolio in the last week, we can see that overall it's down about 1.5%, and I've seen a loss of about $1,000 just in the last 7 days. And the biggest drop in the portfolio came right here on April 10th. We can see the portfolio really just jumped off a cliff right here. And just in this one day, I was down about $1,400, which represents about a 2% drop. And this might actually have been my worst day on the market so far this year. And I'm sure you guys felt this too. This drop came as a result of another hotter than expected consumer inflation report, which showed that inflation is still sticking around. And because of this, the Federal Reserve will probably not be in much of a rush to cut interest rates, which many investors were hoping would happen soon. They were thinking we'd see some rate cuts starting here in June. And because that no longer seems likely, the market responded with some red. And you might be wondering why that happens. Why does the announcement of interest rates possibly staying higher for longer have such a big impact on which direction share prices move in the stock market? Well, there's a few reasons why they're correlated. The first has to do with the cost of borrowing. When interest rates go up and stay up, it becomes more expensive for companies to borrow money. And because they have to pay more in interest when they do borrow, this can lead to lower profits. Lower profits can then result in lower share prices because investors are anticipating lower earnings for the company. Similarly, higher interest rates can lead to less consumer spending and borrowing. Loans for houses, cars, and other big ticket items become more expensive, so people may choose to spend less or not spend at all. This negatively impacts companies' revenues and earnings, which also leads to lower share prices. Another reason higher interest rates push share prices down is because when interest rates go up, things like bonds and high-yield savings accounts become more attractive to investors because they offer higher than usual returns with less perceivable risk. This causes investors to sell stocks and put their money into other things instead. And because the demand for stocks is high, their share prices go down. And as far as my portfolio goes, these were some of my biggest losers for the week. AbbVie saw the biggest drop across the board. They were down 5.5%. Williams-Sonoma also saw a pretty decent drop. This is the biggest drop I've seen from this company, I think, so far this year, down 4.66%. And then we had some others like Johnson & Johnson and Starbucks that also saw some 3 to 4% losses. Other ones like EPD, Lowe's, KRC, and Southern Company were down between 2 and 2.3%. And then we had quite a few others see some red as well. So I had quite a few stocks take some substantial hits, which on the surface may sound like a bad thing, but this can actually be beneficial for investors. Warren Buffett actually wrote about this in one of the Berkshire Hathaway annual shareholder letters. He wrote, "Even if our partially owned businesses continue to perform well in an economic sense, there will be years when they perform poorly in the market, meaning their share prices will go down. At such times, our net worth could shrink significantly. We will not be distressed by such a shrinkage. If the businesses continue to look attractive and we have cash available, we simply will add to our holdings at even more favorable prices." So in other words, if the business fundamentals remain strong and the company is still performing well in that regard, then a lower share price just means that you can purchase the stock at a discounted rate, and you can buy more shares for the same dollars invested. You have a chance to enhance your position in the company at a better valuation, which is a good thing. And if you're buying dividend stocks, then there's an extra dimension to that, because when the share price goes down, the dividend yield goes up, which means that you're able to lock in a higher cash flow return on the shares that you're purchasing at the lower share price. As we saw a moment ago in my portfolio, there are quite a few opportunities to do exactly that. With the recent drops we've been seeing, there are two companies in particular that I'm looking to start adding to again while the share prices are down. With the first one here being Johnson & Johnson, who is now officially under $150 per share. I love to see that. And if we take a look at the performance in the last month, Johnson & Johnson's really come down. They've seen a 7% loss just in the last 30 days, which leaves them with a year-to-date loss of about 5%. And if we zoom out once more across the last year, J&J is down about 8.6%, and they are pretty dang close there to their 52-week low. Now, Johnson & Johnson is one of the most steady, dependable dividend payers out there. They're a dividend king with a 61-year dividend growth streak, and right now the yield is sitting about 16.5% above the 5-year average, which means you're able to lock in a higher cash flow return than usual, considerably higher cash flow return. And dividend stats aside, fundamentally this company is still rock solid and continues to generate consistent revenue growth, consistent free cash flow growth, which is how they're able to continue raising the dividend, and consistently high returns on invested capital, around 19% on average for the last 5 years. And return on invested capital is a metric I don't talk about all too often on the channel, but it's an important one to take into consideration. So essentially, return on invested capital indicates how well a company utilizes its capital to generate returns. returns. A high return on invested capital suggests that the company is effectively deploying its money, whereas a low return on invested capital may be a sign of inefficiencies or poor investment decisions within the company. Overall, higher returns on invested capital should lead to more profits for the company, which they can then use to reinvest back into the business, which is obviously beneficial. They can use that to buy back shares, or they can use that to pay increasing dividends, in the case of Johnson & Johnson, out to shareholders. But anyway, looking at my J&J position back over here on GetQuinn, we can see that across both of my portfolios, my main taxable account and my Roth IRA, J&J is my fourth largest position. And right now I have about 32.3 shares at an average cost of $160.45, which means that overall I'm seeing about a 7.2% loss. So by buying now and by adding to this position at current prices, I can shorten the gap between my average cost per share and the current share price, which ultimately would leave me in a better spot and with more shares of what I think is a fantastic and dependable dividend king. So this is one that I'm looking forward to adding to again. And then the other stock that I'm looking to add some more to, guys, is Starbucks. Of course it is. This one's no surprise. Many of you know that Starbucks is one of my favorite companies, and with a 6.7% drop in the last 30 days and a sub $90 share price almost to mid 80s now, how could I resist? Zooming out, looking at Starbucks' year-to-date performance, they've seen an even bigger drop and are down 10.5%, which leaves them with a drop, zooming out once more, in the last year of 18%. So across all three time periods, Starbucks is down in the red, just keeps getting cheaper and cheaper, and they're also sitting right there at their 52-week low. And then looking at my position back over on GetQuinn, Starbucks is my sixth largest position, and right now I have about 50.5 shares of this company at an average cost per share of almost $91. So right now I'm sitting at about a 5.5% loss, which would be a fantastic time for me to start adding more shares, especially considering the fact that I can lock in a dividend yield that's over 31% above the 5-year average yield. So we have a good opportunity there, which should turn into an even better opportunity as time goes on, seeing as Starbucks is a dividend growth machine. They've been growing the dividend for the last 13 years and have increased it by nearly 10% on average every year for the last 5 years. And the growth isn't exclusive to the dividend. In fact, they wouldn't be able to grow the dividend if the company wasn't growing financially. And taking a look at that, we can see just how consistently the sales have grown here. That's a really nice revenue growth chart. We can also see how much the earnings per share and free cash flow have grown as well. So this is another one that I'm definitely going to have to start swooping up some more shares of here pretty soon. And in the meantime, I would not at all be upset if both of these companies, Starbucks and J&J, continued to go down in share price and just kept getting cheaper and cheaper. These are both two of my core positions. These are two of my largest positions, as we saw. So I'm really excited to have the opportunity to continue building these out and buying more shares at discounted prices. Here's the problem though. As excited as I am to buy more shares of both of these companies, doing so will take away from what's been my main objective in the portfolio all year, which is to make Visa the largest position in my portfolio. I've been dollar cost averaging into this bad boy every single week since pretty much the end of 2023, which right now leaves me with almost 15 shares at an average cost of $272.65. And I realistically need to get my hands on about 10 more shares of Visa before I feel like the position is where I want to be. So I still have a ways to go, and that's the double-edged sword of dividend investing. It's exciting to see all these discounts and have all these different opportunities that you can take advantage of, but at the same time, it can be a bit overwhelming if you have too many options, you know what I mean? Still though, I'd rather have too many options than not enough, and if you feel the same way, and if you're looking for some more options of stocks to add to your portfolio, then check out this next video right over here. In this one, I'm telling you about 20 different companies. I guarantee you'll be familiar with most of them, if not all of them, but they're all great ones to consider if you're just getting started with investing and are looking for some recognizable names to add to your portfolio. So click right over here to check them out, and I'll see you in the next one.